Now looking at those inflation numbers for September, coming in at 6.7% compared to 5.3% in August. Did you expect that outcome, and could you talk us through some of the major drivers there?
Yes, like you said, it was an increase, a month-to-month increase of 0.8%, which is quite a significant jump. In fact, the biggest since February. We did expect rather the inflation trend to reverse, but by this extent, not by this extent rather. But looking at the breakdown, there's one real standout here, and that's food price inflation, which jumped from 7.3% to 9.2% year on year. On further investigation, you look at the components, and bread and cereal inflation jumped from 6.3 to 11.1%. And this is quite clearly knock-on effects from the global maize shortage that we saw as a result of shortages and poor harvests in the US in the middle of the year. And as such, it's filtering through, admittedly, a bit earlier than expected into the Namibian market. And if you look at food prices, I mean, that alone makes up, or food price inflation makes up 30% of the consumption basket in Namibia. And since we don't produce or store enough grain to safeguard domestic supply, we're largely price takers. And so that was what was mainly or predominantly driving inflation, or that significant spike in inflation.
Well, like you say, it's a bit of a significant spike in inflation, and it was unexpected. Can we expect this trend to continue, this upward trend that we're seeing right now?
Well, taking a short-term view and looking at the October figures, I think the answer is certainly yes. With the transport strike in South Africa, our supply lines have become very susceptible to these shocks. We also import 80% of our fresh produce. So disturbances in these supply lines resulted in shortages of supply, especially of fresh produce. So prices temporarily shot up in the first half of October, which we expect to move on to food price inflation, and of course accompanied by higher grain and maize prices. This will have a further devastating, or not devastating, but compounded effect. Looking forward, there are renewed risks to the inflation outlook as well. I think most importantly, the depreciation of the rand. It's of course tied to the Namibian dollar, and seeing as though Namibia imports a lot more than we export, this will have does not really bode well for our balance of payments. And especially looking at fuel prices, which have already been on an upward trajectory over the last couple of months. Even if global oil prices remain unchanged, petrol prices in Namibian dollar terms will obviously become more expensive, and it'll only perpetuate that upward trajectory. So certainly these factors, coupled with the impending food shortage, or rather high food price inflation, suggests that inflation will approach, if not surpass, 7% going into 2013.
Well, we have the Bank of Namibia due to sit for an interest rate meeting in tomorrow's trading session. What do you think the central bank's decision will be in tomorrow's session, and what are the major, maybe major drivers? What could be the major drivers of this decision?
Well, we must remember that the primary mandate of the Bank of Namibia is not, in fact, an inflation targeting one, but rather to maintain our currency peg with the rand. And even if it were to target inflation, we see most of these driving factors being of a cost-push nature. So there's not much the Bank of Namibia could do to reverse the global inflationary trend. We don't expect a cut given the health of the domestic economy, rather the demand side of the domestic economy. We saw private sector credit growth top 14% in August, which is the last figures available, and that in fact is a 4-year high. So we are seeing a very healthy demand side of the economy. So that also is not a basis for the central bank to cut. And in fact, it could be a bit of a concern, given that in Namibia we don't have a measure of household indebtedness. So when the bank, at the last policy meeting, the bank cut its rates by 50 basis points, somewhat surprisingly. But we don't know whether consumers are in fact deleveraging in their debt, or rather, in fact, getting themselves into more debt. So it's a bit of a risky decision if they decide to cut, but we don't really expect them to. We share common monetary union with South Africa, so we don't really have that much room to cut now. We're only 50 basis points higher than them. So looking forward, it will depend largely on what the SARB do in November, but similarly, they have quite an upward inflation trajectory on the horizon as well, so we don't see much room for further monetary easing.